crashing, hit a wall. Right now, I need a miracle. Hurry up now, I need a miracle. Stranded, reaching out. I call your name, but you're not around. I say your name, but you're not around. I need ya, I need ya, I need you right now. Yeah, I need you right now. So don't let me down. I think I'm losing my mind now. It's in my head, darling, I hope that you'll be here when I need you the most. So don't let me down. Don't let me down. Yeah, don't let me down. Yeah, don't let me down.
Welcome everyone, SFX team. How are you guys doing today? Today we have a very fundamental day, eventful day, and we discussed it yesterday on our previous SFX session. Today we have an extra session, right, covering for the previous week, the session that we missed on Thursday, January 26th. I suppose we're gonna have a lot of, like a little bit less people than per usual here on this session, but today I prepared something special for you guys. I'm gonna teach here a new way of applying volume profile. This was a special session that I prepared for a holiday special in the end of 2022, right? And including the fact, taking into account the fact that today we have a very fundamental event. We have interest rates announced. Let me turn on the screen for a second, and I'm gonna show this first, and then we're gonna get back to the presentation. I'm gonna open it up for you. Now here we have, I'm going to repeat it one more time for those of you who maybe missed yesterday's session or didn't have an opportunity to join. We have OPEC meeting the whole day where we have the decision about the future of oil, right? The OPEC announces the potential cuts of oil production and the amount, the limits of oil production for every single OPEC member separately, right? OPEC and OPEC Plus. This is how they regulate the supply of oil. And remember that OPEC completes around 60% of delivery of oil, supply of oil around the world currently. So depending on the production cuts for oil, if they're gonna take place, right, we eventually gonna see the effect on the oil prices as well. Remember that oil prices were pretty stable in the past couple of months, although we had introduced the price ceiling for Russian oil, right? But OPEC, but the prices of oil were able to be kept pretty steady because of several factors, including the fact that the delivery of Russian oil to Asian countries appeared to be much more difficult and much more expensive than predicted, that forecasted, right? Therefore, Russia still had to sell their oil even on the price ceiling of $60 to European countries, right? And they didn't have an opportunity to fully shift their supply to Asian countries. And also China still had lockdowns after COVID, right? They didn't reopen the country fully, and this delay with reopening also causes less demand of oil in China, which also keeps its steady prices on oil around the world. So depending on depending on the decision of OPEC today, we're gonna have an effect on oil prices, and depending on it, we're gonna have the future of the oil prices for the next couple of months. Beside this, we have, of course, lots of USD events today, right? Very important announcement regarding for USD currency, for US stock market, right? For gold, right? For all the assets that actually are connected to US dollar as well. We have the federal funds rate announcement today at 8 p.m. Central European time. It's my time here now, Eastern Standard Time. Oh, where's my clock? Give me a second. Eastern Standard Time, it's going to be, give me a moment. It's gonna be 2 p.m. Eastern time. Guys, we're gonna have announce the Federal Reserve federal funds rate, and a quick mark as well regarding this. Remember that the forecasted good, if you can say so, increase in the interest rate is 25 base point, right? So it's increase that is expected by the market, and it is not going to have such a drastic effect on the market. Remember that the 2022 was the most aggressive year if it comes to the monetary policy of United States, and increased counted 50 to 75 base points every single month. Now, if 25 points will not have such a big negative effect. On the other hand, if FOMC decides Federal Reserve decides to increase interest rates by 50 or 75 base points, we're gonna have again the crash in the stock market. If you do not quite know yet how interest rates influence the market, you can find the recordings in my Forex channel where I explain the fundamentals for 2023, where we went over the interest rates as well and their effect and what can we expect for 2023 regarding the Federal Reserve monetary policy. Besides, we have some other USD events, but lots of people will be mainly waiting for FOMC press conference and their statement regarding the federal funds rate. Including all these facts together, I do not trade today myself, and I do not recommend trading for anyone else today, because most of the US based market is going to be just consolidating and waiting for the federal funds rate statement. And oil market is going to be affected by OPEC statement regarding the production cuts. So we're going to stay away from this and include, take into account this. I'm going to take this session, to take a moment to introduce you to the new, to the new way of seeing volume profile. It's something again that I taught already on the holiday special in the end of 2022. Therefore, for some of you, if you had a chance to attend, this information will not be new. But if you miss the session, the special holiday session in December, this is something that is going to be heard from by you for the first time. So let's get it started. Some of this information, again, for those of you who are familiar with volume profile topic and understanding, it's going to be quite already known. But the second part is going to be introducing the new way of applying and seeing and evaluating the volume profile itself. Just give me one moment and we're going to get started in a second. So the first question is, right, why does the price move in the market? I think this is a question that every single one of us need to ask ourselves, because what a lot of people do is that they only ask themselves a question of where will the price go next, or where will the price move, because the only things that they focus on is making profits when they are learning how to trade. The problem is that you can't make profits in trading if you do not understand why the price moves before asking yourself a question where the price will move next. Furthermore, you cannot even predict the next movement of the price if you do not understand the price nature. So this is where I want to start today's session. I want to give you you an answer, right? And like brainstorm with you. Why does the price in general move? Now, what a lot of people think is that the price moves because we have more buyers or more sellers on one of the sides, right? The price moves up, that's because there are more buyers and sellers currently, and there is more demand than supply, and the price moves down. A lot of people think because we have more supply than demand. The problem is that market auction doesn't work like this. If you think about this, if you have 5 people who want to buy and you have 10 people who want to sell, now I'm asking you a question: how many orders will be actually filled? I mean, if you have 10 sellers who want to sell you a fish and there are 5 buyers who want to buy a fish, we'll only have 5 transactions, right? Why? Because we're gonna have only 5 buyers who will want to buy from this 5 sellers, and another 5 sellers are not going to have their fish sold because there is just not enough demand for their supply. So the price cannot move because there is more buyers and sellers. It's not even possible technically to have more buyers than sellers or sellers than buyers in any given moment of time in the market. Right? There is always equal amount of buyers and sellers in the market. Now, I already explained this concept in our SFX session. So if you go to my SFX favorite sessions right in this channel, and you will find the market auction session. This is one of the sessions of the course of derivatives. This is where you will find the pretty clear explanation on why the price moves the way it moves and how the orders are actually getting filled. And now the short explanation about this, because I still want to introduce this concept today, is because of the aggressive and passive orders. We have 2 types of orders in the market. Aggressive on the left side we have on our screen, and passive on the right side of our screen. Now, aggressive orders are, as you probably already read, are buy by market and sell by market orders. Those are the orders that are getting filled by the market price right now. Those are the orders where traders want to enter the market immediately, right now, without specifying the price from the first passive seller. Okay? Now, again, this should be actually without specifying the price. So it does not matter for them at which price they're gonna buy or sell. They just come in the market and they say, I want to buy or I want to sell right now. Give me the first available offer. All right. And this is how they get it filled, right? Buy by market orders, they match with the first available sell limit order. And the sell by market orders match the first available buy limit order. Okay, so aggressive orders always match with passive ones. Now the passive orders, on the other hand, are, as you probably already guessed, buy limits and sell limits. Those are limit pending orders where traders specify the price they want to enter the market at. And they patiently wait until the aggressive traders come in and agrees on their offered price. Let's say I want to sell like 10 fishes, and I say I'm only gonna sell 10 fish, every single fish by €5 each per kilogram. Let's say like this. And I'm not gonna sell for a price less than this. And I'm patiently waiting until I have a buyer who agrees on my price. Okay? And those are the passive orders that are just sitting there. They have their passive orders, limit orders placed, and they're waiting until someone is going to get their orders filled, if it makes sense. Okay? Now, passive sellers require aggressive buyers to be filled in, of course. They require someone who's going to come in and they're going to sell, I'm going to buy from you at your price right now. On the other hand, passive buyers by limit orders, they require aggressive sellers to be filled in. Now, we already know now how does the price move. The price moves when we have more aggressive buyers. The price moves up because the orders on the buy aggressive orders are getting filled faster than sell limit orders. So they are pushing the price higher. And on the other hand, when we have more aggressive sellers, those who sell by market, in the current situation, this is where the price moves down. Let me know in the chat box if it makes sense for you. If it's clear for you, let me know in the chat box. And in the end of the session, I'm going to enter our chat box and see if you have any question there. Right, but for now, let me know if this is clear. This is like a clear concept for you of how the price moves. Okay? Now, since we know how the price moves already, right? Let's have this example in front of you. As we can see here, the price has been consolidating for quite a while, right? It gave us a pullback. And then we see this huge move to the upside, the first big impulse to the upside. Just a few candles and the price flies. Those were aggressive buy orders, right? That were matching with the previous sell limits that were placed on these levels. We see that the buyers, aggressive buyers, jumped in the market and they just filled in all the sell limit orders that were above the current market price. And by doing so, they moved the price to the upside. When the price went up sufficiently, price faces new big sell limit orders, which are located between 4,000 and 4,045 price area. Currently, all the buyers already got their orders filled in. And when they reach this huge sell limits, we don't have any more aggressive buyers enough to break through this massive sell limit area. It doesn't make sense. This is how the price stops, because aggressive buyers already had their orders filled in earlier on the lower levels, and by the time they reach this huge supply area on 4,000 on 45 area, we do not have left by aggressive buyers, but we have lots of passive sellers. Okay, so what we can see here, we have massive sell limits and last few buyers who are left at this moment. The volume of aggressive or massive sell limit is massive passive sell limits is much bigger than the volume traded by aggressive buyers. And this is where the price starts to reverse and slow down. I need you to remember, and I write down if you didn't yet from the previous session, that price moves because of buy by market and sell by market orders. So market orders move the price and limit orders stop the price. So every time the price reverses, it's because it's facing a big amount of limit orders and there is not enough aggressive orders which would push the price through. So again, I'm going to repeat it one more time. Market orders move the price, limit orders stop the price. Okay? So this is what we have now. Again, here for example, how the buyers got their orders distributed. They cannot distribute, let's say they want to buy 1,000 contracts or 1,000 lot sizes, right? They cannot buy 1,000 lot sizes at one specific time. I cannot enter the market and say, okay, I want to buy, or let's say not every market I can come in and say I want to buy 1,000 contracts of this asset, because we do not have just enough sellers. We may not have enough offer to be able to fill my 1,000 contracts demand. Okay? So why the price is moving up is because different sell limit orders are located on different prices. And my buy limit, my buy by market, my 1,000 contracts buy by market is automatically by the market broken down by smaller pieces and filled in as the closest opportunity price levels. For example, I enter and my first buy is getting filled in all the way down here. But after this, there is no one who is selling. So my next 100 contract sell is going to be only on the next level where there is another seller who is offering another sell order. It's a very basic explanation, because here it can be filled by a 1 contract, 5 contracts, 10 contracts, 100 contracts, 150, 10, and so on and so on. But I want you to understand the principle, right? So what we see is that the price breaks down, right? My big order breaks down by the small orders and getting filled at the closest available opportunity for a sell. Again, 100 contracts, and then for a while there is no sellers anymore. And then the price gets filled another 400 contracts by higher, because this is where the next seller was. And so on and so on. So this is why the price moves up, because my big order, aggressive buy order, needed to be pushed higher to be able to fill it in. Okay? So the question, since we already know how the price moves, the next question is how and who moves the price, and why the volumes are so important. Why do we trade volumes every single session, right? Well, let's have a look at this table. The table on the right side, which is taken by from Wikipedia, it shows us that roughly 80% of all the currency volume is transacted by only 10 financial institutions. They have the absolute majority. They move and manipulate the price, right? It is absolutely their game. We see that around 80% of total amount of volume is distributed by these 10 big market participants. Do you know we have a slightest chance? Do you think we have a slightest chance to have any effect on this market? Not even the smallest one, because 80% by default is traded by them, and then another 10 to 15% is traded by another big players who are not in this list. And we have the small percentage in the market that even if we would all come together, we would not have such a big influence in the market at all. So the only way for us to trade in the market is to be able to trade with these big market participants who are moving the price, not against them. Because if we're gonna try trading against them, guess what? We're always gonna fail. We're always gonna fail. And this, by the way, does not apply only for stock market or currency market, right? This was a currency explanation. Stock market has more or less the same division of the volume. Now, this is the table for the cryptocurrency. If you look at the cryptocurrency market, you can see that it is identical. And although the data here on the right side is a little bit outdated because it's taken from 2017, if I'm not mistaken, okay, it still didn't change much from that moment on. And although lots of people think that Bitcoin and cryptocurrencies are they are decentralized and this is why they are not manipulated, well, I want to break, I have to break your expectations. It's far from that. It's far from being decentralized, and it's far from being not manipulated. And in this picture, you can clearly see that only 4.11% of addresses of Bitcoin, this is financial groups, own 96.5% of all the Bitcoins, guys. 4% of the addresses, they own 96.5% of all Bitcoin. This is crazy, right? On the other hand, at the bottom of the picture, you can see there's a small little share that the retail traders own. This is us. The small little share, right? This is where we see here. This is where we see potential, this is where the retail traders are. All of this is market makers, a big market participant who decide where the market moves. And it's the same for currencies, major cryptocurrencies, stocks, indices, and the market is always dominated, moved and manipulated by a few big institutions as financial groups. So if we need to try to trade with them rather than against them, the question is, how do we do this, right? And how do we track this big volume? Well, now this is going to be some information that lots of you actually already know about. So I'm going to skip through this very fast, okay? We're not going to dive deep into the volume profile explanation. Why I'm not going to spend a lot of time on this, because most of you already know what volume profile is. And after this, I'm going to jump into the introduction of how to apply the volume profile in a new way, not the one that was introduced in the bootcamp. So as you probably already know, for those of you who don't know yet, right, what in general is volume? Well, volume, it's all asks plus all bids. And now what asks are and what bids are. I'm gonna exit this for a second. Okay, the question is what are asks and what are bids? Well, asks, okay, those are all buy by markets, buy limits, and stop losses of sellers. And bids are all sell-by markets, all sell limits, and stop losses of buyers. So all the orders that have ever been filled in, okay, that have ever took place in the market, including hit stop losses. Why the stop losses of sellers and buyers? Because if you already trade futures, and I explained it in the previous session, that especially in the Derivatives 101 course, to be able to close a future transaction, you need the opposite transaction for the same amount of contracts. So if you have one buy contract running on mini S&P 500, to close this trade, you need to sell one contract of mini S&P 500 of the equal instrument. Okay, so if you owe something, you need to sell it. And if you sold something, you need to buy it back. Okay, this is how it works. Therefore, asks are also stop losses of sellers and bids are also stop losses of buyers. Let me know in the chat box if this also is clear. I see the chat box. I see you guys feedback. Yes, it's great, makes sense, clear, very manipulated. Wow, fantastic. I'm happy. The information helps. Let me know in the chat box if this is also clear. And if you have any questions, please type them in the chat box as well. In the end of today's session, I'm going to go over this together with you. So we have two different volumes, as you already know as well. We have volume indicator, which just says volume. And this is the indicator on the bottom of our screen. This is vertical volume, right? Normal volume. You see it everywhere. The first time you open any single chart, including your MetaTrader 4 TradingView, ATAS, everywhere, this indicator will be there. This is a volume on the bottom which is distributed by time. So every single bar is showing you how much volume was traded on every single candle. And because our Japanese candlesticks depend on time, they are built based on time, our volume indicator is also built on time. So this is a volume by time. On the other hand, a little bit higher, we see volume profile, right? This is a volume by price. It shows us how much volume was traded on every single price level. Okay, so where the histogram is increasing, this is where the bigger amount of volumes were traded, and where the histogram is decreasing, we see clearly that this is where the smallest amount of volume was traded. You can immediately see with the naked eye that most of the volume is usually traded during ranges, consolidations. It's not just without reason that I'm saying every single session that consolidation is accumulation of volume, consolidation is accumulation of volume, consolidation is accumulation of volume. I mean, I repeat it a lot. I'm getting tired of this sometimes, yes, but because this is just an ultimate truth. Consolidation is the area where the volume getting accumulated. Therefore, we need to know that most of the volumes are always traded there and how to approach this correctly to make profits and benefits from it rather than losses. So we have these two types of volume. If you want to learn more about it, I'm going to a little bit talk about it now for a few minutes. If you want to in-depth knowledge on my Forex channel, there is a whole bootcamp where you can find this information and where you can in-depth dive into volume profile studies and break it down into the smaller parts. And all of this is done on Forex channel. You will find it all there. Quick definition again, right? I already said it. So we're not going to go over it. Again, volume indicator is used to measure how much of given financial asset has traded in a specific period of time. So as I said, the time-based volume. On the other hand, volume profile, the price-based volume. So it displays trading activity over a specific period of time, a specific price level. So it takes into account both price and time, which is quite important because we do not miss a very important part of our chart analysis if we use volume profile. Okay, so the question can be where to get volume profile. Well, you can find volume profile indicator on every single almost platform, right? If you trade Forex and CFD, which is contracts for difference, you can find them on such analytical platforms as TradingView, which we use during our sessions. and MetaTrader 4. TradingView has it by default there, so you can go and you can find multiple indicators. It's also in my favorite sessions on how to set up your TradingView chart. I showed multiple indicators of volume profile, which you can add. MetaTrader 4, though, on the other hand, will require you to download the custom-made indicator. Okay, so MetaTrader 4 will need you to find the custom-made indicator and install it there, because by default they don't have it in their platform. Now, on the other hand, if you trade futures, whatever it is, it can be also stocks, it can be commodities futures, index, stock index futures, cryptocurrency futures, currency futures, right? Everything. You will need to take futures analytical platforms, and you can find volume profile on such platforms as NinjaTrader and ATAS. ATAS, by the way, is also introduced in my favorite session. So if you are not familiar with futures analytical platforms, in my favorite sessions, I have 3 different sessions on how to use ATAS, why ATAS, how to create your workspace, and everything is right there. You can find it by just going to favorite sessions. It's named, so it's going to be very easy for you to watch and learn it. And I also show you how to add your volume profile in ATAS immediately. Okay? Now, quickly about the components of volume profile before we're going to continue with the next one. As you already, most of you know, right, who go to this session, attend these sessions, right, we have several components, which are, some of them are more important, some of them are less important. On the left side, we have visually, I broke down the volume profile by parts, okay, and let's start with a big red area, a big red line in the middle. This big red line in the middle is the point of control. The point of control is the price line on your volume profile with the highest traded volume, which means that during this whole volume profile being formed, the most amount of contracts were traded on point of control, the highest interest volume level. Point of control is just one of the extremes. So if you will see, we have several extremes of volume on our chart, and all of them are meaningful and important. And we trade using all the extremes, not only point of control itself. Again, more of it in a moment. But point of control itself is the biggest volume traded line. And also, this is why it's red and bold, because we never want to miss out the price touching point of control, because usually when the price comes back to point of control, because such a big volume protects this area, it usually reverses from there. Again, more about it in a second, how we actually can apply it. Beside this, we have profile high and low. This is just a starting and the end point of volume. You can choose it manually. The profile high is the highest reach price level during the specific period of time that you choose. Profile low is the lowest reach price level during a specific period of time. Okay, so you can just manually place it. It's very easy, right? Again, it's in my favorite sessions. You can find how to do this. You can choose where to place your volume profile, and profile low and high are going to be a custom places, just the starting and the end point of your volume profile, depending on how you place it. Now, value area high and low. Value area is a darker gray area, and we see that this is separated by 2 bold black lines. I especially did it manually. This dark gray area, which is called value area, is 70% of all volume that was traded during this point volume profile. So let's say we have 1,000 contracts in all this, let's say, okay, let's more realistically, we have 100,000 contracts in this all price range traded. 70,000 from it will be traded in this gray area, and the rest of 30,000 will be divided between the lower and the higher lighter areas. Make sense? Value area high and low are very simply just the highest price level within the value area and the lowest price level within the value area accordingly. So it's very easy. Some people also use it to trade. I don't personally use it to trade, but I wanted to break it down for you to make sure that you understand all the parts and components of volume profile itself. Now, volume nodes, as I said before, are the extremes, volume extremes, right? Or volume nodes, however you want to call them. Those are the big high volume accumulation area, and it follows activity of institutions. So this is where the institutions were most active. The point of control is the highest accumulated volume volume node. So this is where the biggest volume node within the volume profile. Now, as we can see here on this quick introduction, on this quick charts, is that how usually price goes is the price comes back to point of control and rejects from it. As we can see here, during volume profile being traded, volume profile being formed, right? We have the biggest volume accumulation area right here, where my mouse is. And we had the red line, which represents a point of control. We see that the price went up, meaning that most of the orders inside of this range were buy orders of institutions, because the price only goes in the favorable direction of institutions. And when the price comes back to this point of control, it rejects from there. Why? Because the most of these buys are still opened and institutions keep protecting their levels. So the price rejects the point of control in the same direction where the price went previously. Oops. Now, the same happens here. As we can see again, volume profile been formed. The most volume has been traded on point of control. The price goes away from point of control, comes back, and we see the rejection in the same direction where the price was previously. It can be broken down as simple as follows. If the price is below the point of control, when the price comes back to point of control, we look for sells from point of control. And on the other hand, if the price is above point of control, when the price comes back, we look for buys from point of control. It's as simple as that. No rocket science. Very clear and straightforward. Again, let me know in the chat box if this is understandable and if you have any questions. And we're gonna continue. Now, what I wanted to introduce to you today, and this is what I prepared for their holiday special, is a little bit of a new way of analyzing volume profile, because what I noticed is that people have difficulties understanding where to take trades on the volume profile itself, right? And how to place volume profile. A lot of people don't take trades from extremes, and the only things that they look for is point of control itself, or they are getting confused on which point of control to use. And lots of the times I get the charts where people use the point of control which is 3 months old, right? Which we don't use. Therefore, I went ahead and I prepared this session for you, so you can know immediately from the first look at the market and placing one thing as volume profile on your chart. You can know immediately what to expect and when your next trade will take place. I see, guys, clear, amazing. So let's go ahead, right? We have several profile setups which I want to introduce to you today. One of them, and first of them, is a thin volume profile setup. Thin profile setup. What does it mean? What we see here is that thin volume profile is a profile that usually has more or less equal volume distributed throughout the whole volume profile. What we can see is that we have several big extremes, right? And thin impulsive profile, thin volume profile, we evaluate from the trend. So we always place our volume profile from the lowest to the highest point within the uptrend, and from the highest to the lowest point within the downtrend. And thin volume profile, again, is when all the extremes are more or less the same size and the volume was equally distributed throughout the whole volume profile. What we see here, that the volume cluster created within the trend shows where the volumes were the heaviest, okay? I especially deleted my point of control, because this is not about the point of control. It is about searching for the biggest volume accumulation area, the biggest volume node within the scene profile. We see that volume cluster created within a strong uptrend indicates that buyers were adding up to their positions in this volume cluster. Breaking it down, the price went up. This is where major buyers started to aggressively buy the asset. When the price reached this area, buyers were pushing the price a little lower because they were adding up to their buy positions before the next push to the upside. So when the price comes back to the same area, this huge buy power that was accumulated within this area keeps the price up. And we see the price comes, and after this huge long candle, which was supposedly a news event, the price drops, it touches the volume, the big no volume node, and reverses to the upside. Let's have a sell example. Again, we have the scene volume profile, right? We don't have like major volumes, and we see that it was pretty equally distributed, but we see two volume nodes which are standing out, right? They are pretty standing out. They're the biggest within this trend. Again, attention, it's placed from the highest point to the lowest point of the trend. The volume cluster created within a strong downtrend indicates for us that sellers were adding to their short positions in this volume area. So we had the first push to the downside, and then within these two areas, sellers were adding up to their sell position. They were opening more and more sell positions. Therefore, when the price reversed to them, we see two beautiful rejections. First rejection from the first volume node, and the second rejection from the second volume node. And I especially took two different instruments. The first one was a mini S&P 500. The second one was 6E, which is Euro futures, right here. So we see that the price beautifully rejected both on stock index futures and currency futures as well. So it works for every single instrument. Now let's continue, right? Another example of scene volume profile. Again, we see that volume is pretty equally distributed, but one volume node standing out because it's the biggest. It's even visually represented, even without point of control, as we can see. It's also Euro futures on 30 minutes time frame. If we place the vertical line, we will see that this volume node was the highest. And when the price, again, the buyers were adding up to their position. So when the price comes back to the same area, we see the beautiful touch of the pin. And the price continues to the upside and give us a beautiful rejection as well. Also, Euro futures on 30 minutes time frame. Another example, also Euro futures on 30 minutes time frame, right? Beautiful again, the biggest volume node from all of them. The price completes the trend, comes back, gives us this pullback, and continues to the upside. And before, we also saw this rejection to the downside from the same node. So technically, you were able to sell and buy from the same volume node 2 times, right? One sell and one buy. I usually only take 2 trades from every single volume extreme, including point of control itself. One sell and one buy from every level to not overdo this. Also, beautiful example. I prefer to take trades when the trend is completed. So when the trend is completed here, only after this, I take the second correction on the trend. Okay, now here is a small bonus for you of how you can make thin volume profile even stronger. This is a special case of this particular thin volume setup is when it is in confluence with the support becoming resistance and vice versa setup. A confluence of those two setups create the most powerful support and resistance zones. what we see here is it is a daily time frame, but you can also find these examples on the smaller time frames. The price rejected this price, the support, right, 5 times before sellers push the price through. First rejection, second, third, fourth, fifth. And we see that during these touches, we had a huge volume accumulation here. So when the sellers pushed the price through, we knew that this volume area was previously at the control of buyers. And because we had huge volume accumulation there, we also knew that this volume now is passed over to the control of sellers. So when the price comes back to the same volume area, we have 2 setups in confluence. First, support became a resistance, and secondary, our seen volume profile setup took place right here as well, because the price came, we had beautiful rejections and the drop. Again, this is daily time frame, but you can find these examples on every single time frame. You just need to look and be patient, and you will have lots of them. This is one of the strongest setups you can ever find in the market. Now another one, this was a thin profile setup. Now another one that I want to show you is a range setup. Again, most of you already know this one, but I want to repeat it again to make it clear. Okay, the scene profile takes place in the trend. The range setup takes place after the range being formed. So the first step you need to do is you need to find the area where the price was ranging. Ranging meaning it fits in the rectangle. This is a very easy explanation, and I think very accurate explanation of the range. What is the range? Well, the price is not moving anywhere. It just moves horizontally, right? It just moves and fits into the rectangle. If it does, this is a range. This is your point. This is your moment. So when we see the range, what you do is you place your volume profile from the first candle of the range to the last candles of the range. So somewhere when the first rejection happened, the first support or resistance was created, and till the last candles where the price starts breaking out. Okay? So we see that this range or rotation area, however you want to call it, when the price exited to the upside, it shows us that strong buyers were accumulating their positions in this area. And since price went up and the biggest volume was created on point of control of 84.98, this was the heaviest volume accumulation area, and most buys were executed right here. So buyers now are in control of this buy volume, buy point of control, long point of control. What we see after this, that the strong buyers, right, we are accumulating their orders, and when the price returns to the volume accumulation area, point of control specifically, strong buyers start to defend their positions aggressively. This means that the strong buyers start aggressively buying asset instrument to drive the price upwards again. And we see the beautiful boomerang move, right? What I call a boomerang move. We had a move to the upside, the price came back like a boomerang to the point of control and reversed from there, jumped from this point of control like a ball, right? Beautiful rejection, touch and jump. And this is where we look for buys. This is where we look for long trades, right? Again, boomerang move, range setup on the left side, point of control, and long trade. Now let's have a look at the sell scenario. Short scenario looks exactly the same but reversed. So again, we had the rotation area. Strong sellers were accumulating their positions in this range before the price went down, and because the price went down after the range, we know those were sellers. Okay. So when the price comes back and completes this boomerang move again, guess what? The aggressive sellers start defending their previous short positions, continuously selling aggressively and pushing the price again to the downside. And we're gonna again see on the touch to the point of control, we sell in the same direction that was a breakout of the previous consolidation. You know what lots of people do? Lots of people Sorry guys, that is like not supposed to be here. I'm not even using a top anymore. Anyway, what a lot of people do is that they try to sell on the support. So they try to sell here when the price was support recently. And by the time the price reaches point of control, the biggest volume, they're already out of their stop losses. Their stop losses got hit. And instead of selling break and retest kind of scenario, which is quite outdated already by the current time of the market, we sell from the biggest volume accumulation area, so from the point of control itself. Make sense? Now another scenario, again, also sell scenario. Again, another range, another boomerang move, quite fast one because of the news. And we see again the price came back, was holding this volume for a little bit and dropped like a stone after facing this range point of control. Sellers defining their positions, add up to their sell positions that was opened earlier, and drove the price to the downside. We already know two setups, right? We know thin setup and we know the range setup. Now we have two more left, okay? One of them is called B setup, and now you will see in a second why it is called B setup. It's very easy, it's straightforward. It's because when it shapes, its correct way to call it would be this actually. Small B setup. Sorry guys, I'm gonna adjust it quickly. Here we go. This is the right way to call it. Why? Because when the price is forming the volume profile, we see that the biggest volume accumulation area is located on the bottom, and on the top there is almost nothing. So if you draw the ladder B, it's gonna be pretty much the volume profile shape, right? It's very easy. Bottom on the left, like on the bottom, the big volume accumulation area, on the top, nothing. So B-shaped impulsive volume. We also place it on the trend, so from the lowest to the highest point of the trend, usually, right? And it's a mini S&P 500 futures chart on 1 hour time frame. It's very straightforward because the biggest volume accumulation area and the only one in the B setup, remember it's the only volume area, is located on the downside. So we take the point of control of this B setup and we buy from it when the price comes to the point of control again. The same scenario here, again, we have the B setup, the big volume accumulation area on the downside, almost nothing on the top. So when the trend is completed, on the retest of the B volume, B point of control, we buy, we go long. And we see a beautiful rejection again from the same level. So this was B setup, and now we have another one, P setup. And you probably already guessed why is it called the P setup. Again, very straightforward. P setup is just because it's reversed to the B. And the P setup, the most volume has on the top of it. So when the trend is completed, the biggest volume, the heaviest volume was on the top and almost nothing on the bottom. So you can draw the P ladder and it's going to be pretty much the shape of your volume profile. So when the price comes back to the point of control of the P setup, which is going to be obviously on top because this is where the heaviest volume is located, we go short, we sell from it. Because the only volume within P setup is located on top now, right? Very important to remember that within scene profile setup, so the first setup that we discussed today, there are several big volume nodes, and B and P setups, they only have one big volume node. B setup on the bottom and P setup on the top, okay? B setups usually are used for buys, so they are formed on the downtrend and they're all uptrend, like they are used for buys basically. So when the price comes back to the B volume, we go long. When the price comes back to the P volume, we usually go short. Why? Because P volumes, right, are usually, P volume is usually above the price. Make sense? So what we see again, the P volume here, I didn't even draw it, it's pretty obvious, huge volume area on the top, the heaviest and the only volume area is on the top. Point of control is right here, so when the price comes back, we go short from the same P volume point of control. And this was a 6B chart, so the pound futures on 1 hour time frame. So as you can see, it works on every single instrument, on the currency futures, stock index futures. It's gonna work on cryptocurrency futures, commodities futures, and on everything you prefer, because the principle is exactly the same. Another example here, not the perfect one because there is some volume here, but still applies to the P volume, and this is a mini S&P 500, 30 minutes time frame, right? So we see that the P setup, again, we go short from the point of control of it. So when the price comes back, gives us a boomerang move, we go short from the same exact P point of control. All right? Now the question is, I see already Alexandra adopted a question in the chat box. I'm gonna come back to it after I finish. Now we have one more important topic. We have how to place two more. How to place take profit and how to place stop loss. This I see also a lot of people actually do struggle with. So let's discuss it very quickly. Now, how do we place take profit? Well, we trade from volume to volume. This is a principle I need you to understand, because once you really deeply understand this, take profit and stop loss placements are going to be extremely easy for you. Take profit placement is on the next point of control, of the closest point of control to your entry. For example, we had the consolidation, we had the range setup. The price goes away, completes the boomerang move, and we take short. Where is the closest point of control? Well, on the point of the volume profile of this trend. So if we place the point of volume profile of this trend, we will get this point of control here, and this will be our take profit. Now, of course, a quick remark, I give it a couple of space move. You will never see me placing my take profit right on point of control. You will always see me placing my take profit with a little bit pips, a couple of pips extra, because I take this couple of steps, a couple of pips for the price mistake, and also for the spread which you have if you trade CFD and currencies. Okay. So what we see here is that we trade literally from volume to volume. We trade from point of control to point of control. It's very easy, right? Another example, we had a P setup here, and we had not necessarily a setup, right? Also the P setup, but a little bit worse P setup than the previous one. What we see here, we take short from the one P setup, and we take profit on another P setup. It's as simple as that, right? Easy. Those were the explanation about take profit. Now, stop loss is apparently not in this presentation. Where do we place our stop loss? We place our stop loss above the volume range. Now, not above the point of control, but above the volume area. What do I mean by that? I mean by that if, for example, I have this range setup. My point of control is here, and the volume node of this point of control is right here. From the moment it starts forming till the moment it finishes its formation. This is it. So my stop loss will go above the volume node in the first low volume area. In this case, the first volume low, the closest one is here. The best one is above, is right here, right? The best stop loss placement in this case would be on the next volume dip, which is here. This is a volume dip, and this would be our stop loss. Okay, now another example on the next one. If we take a short here, our stop loss also needs to go in the next volume dip, right? And the next volume dip should go above this trend. Why? Because we see that this volume still continues. So our first stop loss should go above all of these dips here, right? And only after this we can take our stop loss. Why? Because if the price would go far beyond this volume area, this is the only moment where we would say that our trade is invalidated. Now if you go to the left side, for example, anywhere, here, there, let's start with this one. Our stop loss would go also above this volume area, right? We see that this volume area is still continuous. I'm gonna type it, I'm gonna show it again. This volume area is still continuous, as we can see. Starting from here till here. Let's put the opacity lower, make opacity lower to make it clear. You see, this volume areas is still continue. So our stop loss should go in the first volume dip around here. The same would apply to the next one. If this is our volume areas, our stop loss should go in the first market dip, preferably all the way up here. The closest you could place it would be all the way here in this small dip. The best one would be placement above it. Make sense? This is where we would take it. Now, let me know in the chat box if you have any questions, and in the meantime, I'm gonna go over the questions that are already there and answer them. I see Alexandra is asking the question in the chat box. After the initial move or wave happens, you wait for correction, then trade the pullback. Yes, I always trade the pullbacks. Smaller pullbacks, bigger pullbacks. If you go to my... Here, for example, yesterday's S&P 500, which we, by the way, crashed all our goal set. It was a beautiful move here from S&P 500 for 27 and a half points, which is 270 pips move. On yesterday's session, what we had here is that we had the first move happening, then we had pullback, and this is where we had our two hit levels, and then we traded the continuation. The same would be with this US oil in a second. We traded it here last week, right? This was something that I wanted to share, but I didn't, because I didn't like how it looked. We traded this in the beginning of this week. We traded the first wave of the move, correction, and the downside. So yes, I trade pullbacks the most. Or again, the pullback from the range. For example, here was a range setup. That was a range. We had the move to the upside, we had the come back to the point of control of this range, and we had the move to the upside. Also the correction and continuation. Let me see, Victoria is asking the question, what still confuses me, like in 6B at 1 hour, let me see. 6B 1 hour, right open here. Candle closes above before going short. Because this is a big trend. If you are looking for this first, again, I only look for the closure above this big volume area. This is where you place, you see me, Victoria, for a reason, placing my stop losses. Because if we would only trade our point of control. If we would only trade point of control, right? We would place stop loss on the point of control and we say, okay, if the price closes above point of control, we are out. But I don't do so. I place my stop loss above the volume node for a reason, right here. Why? Because I need the price to stay within this volume, because the price does not reject the point of control. It rejects the volume node. This is the whole today's training about, right? Like a thin volume setup, exactly the same principle applies to all the setups. We do not think, right? We do not trade the point of control. We trade the volume accumulation areas. Therefore, if point of control gets broken, it doesn't mean the price is breaking the volume area yet. Okay? We only think that our setup is accumulated, right? We only can take our setup as not accumulated but invalidated if the price breaks the volume node, not the point of control. Victoria, let me know if it makes sense for you. For example, here, right? This I already deleted. Now let me check quickly. Actually, that was good. Here. This is S&P 500 from Monday. My hit level is below, like one point below point of control. My stop loss is not on the point of control. My stop loss is a little bit higher. Why? Because I'm not expecting the price to reject point of control. I'm expecting the price to reject the volume node. I'm not sure if there will be visible it. It will be visible here. This volume node, right? We see that volume accumulation area is everywhere here, not only point of control itself. This was a sell and now a buy on yesterday's one was right here. Why is my stop loss not on the point of control? Why do I not think, okay, my trade is invalidated if 1 hour would close below point of control? No, I say my invalidation area goes below the volume area, not below the point of control. Here, for example, my volume area was this one, this here, all of this here. And my stop loss goes below the volume area, not below point of control. Victoria, does it make sense? Let me know in the chat box. Yes, clear, perfect. So don't see point of control. This is what a lot of people do as a mistake. They see only point of control as an important information. No, we see volume accumulation area as an important information and point of control as only a part of it. Important part, but not the only part, and certainly not the most important part. Alexandra says, this is so good. It's like a condensed version of bootcamp. Yeah, it's a little bit less and it's a little bit different, but yeah, I'm glad you guys love it. I appreciate the kind feedback. I will reward this whenever I need to focus my precision of entries and exits. Perfect. Do you use Fibs for an extra confluence? Joy is asking. Sometimes, not always. As I explained before already, Fibonacci is not my main confirmation. Fibonacci in the session is not about Fibonacci at all. Again, I'm still gonna record the session about Fibonacci, but I do use Fibonacci, not always though. Fibonacci is just an extra thing that can help on the higher time frames, for example, but not something that I use as a first. I'm never gonna take a trade, Joy, if it makes sense, if it's only Fibonacci. I'm gonna take a trade if it's volume profile, point of control, weekly, monthly, and Fibonacci. Then I'm gonna take a trade. Not the opposite way, if it makes sense. I don't see any more questions. I think we did pretty well with today's session, although we had lots of the fundamental events and we were not on the charts, right? We were not trading particularly and analyzing it, but I think it was extremely valuable. If you guys got some value, put me some value in the chat box. Victoria is asking, why is the 1 hour candles confirmation the most reliable ones? It's not the most reliable, it's because I trade 1 hour. It's because I trade intraday trade / swing, like intraday / swing, which is going sometimes overnight. If you would trade scalps, for example, or purely intraday, you would analyze 5 minutes and 15 minutes, and then you would take 15-minute candles. if you were in the session that was on Monday, actually Monday session, I took a trade on Monday on S&P 500, and that was a trade on 5 minutes time frame, and then I used 15-minute candle closure, and because it was on during all market opening with high volatility on the smaller time frame, I would use 15-minute closure as information. Now, because I mainly also trade indices, or stock index futures, they are so volatile that 15 minutes sometimes are false, right? Therefore, I'm waiting for 1 hour. It comes again from the instruments from specifications of instruments that I trade and from the time frame that I trade. But if you would trade different instruments in different time frames, you would of course use different confirmations. If you would trade, for example, purely swing or purely long term, then you would not take confirmation as 1 hour, you would take confirmation as daily. Only if daily would break certain volume levels, you would exit the trade. Also possible, but this is also long-term trading. Okay, so you choose the time frame that is working with your instrument and your trading style. Okay, I think again we made it amazing session. I see some values in the chat box. Thank you for the feedback. I really appreciate this feedback, by the way, in your comments. Sometimes it might seem like it's not a lot, but it actually does a lot. The sessions are not only me talking, right? The sessions are interactive for a reason, because it's like if you speak publicly. The feedback from your audience actually matters and counts, and it gives you some energy. It's like if you have a blog or YouTube channel, right? The comments and likes and feedback actually makes you want to keep going and makes you want to prepare some extra sessions and some information, right? And trainings and videos and podcasts and so on and so on. So if you guys don't have, if it's not difficult, I really highly appreciate every single one of you who are leaving the comments in the chat box, because this really matters and this really makes me feel like it's valuable. It's noticeable that I'm putting in the work, and you guys appreciate it and love it, and it makes me want to give more back to you. Thank you guys a lot for the session. Thank you for attending this extra session. Remember that tomorrow we have one more SFX session for the week. We're gonna be already post the interest rate increase, and we're gonna have some moves in the market. We're gonna discuss all of it and the information. The data release that will be released today in a couple of hours. I appreciate every single one of joining the sessions and your time and your trust in leading and letting me guide you and lead you in this world of trading. I wish you a fantastic rest of your day. Stay alert about the 3.5 hours from now, because we have our interest rates increase. And I will see you guys tomorrow at 9 a.m. instead at the same time, the same channel, on the next SFX session. I appreciate every single one of you. Have a fantastic day, and we'll see you guys tomorrow.